Right, now we're going to move into the industrial sector. The industrial market really rode the wave of the economic growth and population growth up over the last 2 or 3 years, but across the world it's certainly been affected by, especially by repricing. Let's have a look at some of the drivers in the industrial market. There's one that we rely on heavily to tell us where the demand for industrial space is likely to come from, and that's industrial production. The assumption is that this year Australia and Queensland, in fact around the world, industrial production has dropped very rapidly. It's a real sign that demand has come out of the economy. But 2010 will be a much better year, and 2011 better again, and by that point we think Queensland industrial production growth rates will be starting to lead the nation again and be back to levels that the state is accustomed to. One of the biggest changes we've seen in the industrial market is that the amount of construction activity has fallen away very rapidly, not just in Brisbane but certainly around Australia. Last year in Australia there was over 3.5 million square metres of industrial floor space constructed. But we've never seen such a high volume of construction activity in the market. It was a real function of very much the pre-lease demand, the demand from the logistics sector for bigger and bigger sheds and more of them. And South East Queensland is very much part of that trend. We saw over 1 million square metres built in Brisbane in 2008, and that's the highest we've ever recorded. We think this year, as the pre-leasing, the majority of the pre-leasing just stopped with uncertainty about the future, that construction activity also was able to stop very quickly. And it means the potential for a vacancy overhang in industrial is now much less because of the high levels of pre-leasing. So it's almost as though the market has stopped and just sitting in hibernation for a moment until the demand starts to pick up again. But having said that, of course, there still is quite a bit of activity going on there. I think we almost get conditioned to thinking that, okay, every year is going to be 1 million square metre year. Well, of course it isn't. This year is 500,000, but we're used to 1 million, and it seems like there's nothing, but there's really still some activity going on out there. We think 2010 will be, next year will be similar to this year, before the pre-leasing starts to kick in, and the lead times that you need to see the buildings built and finished will mean that by 2011 the construction volumes will start to rise again. Yeah, it's interesting. This chart just shows you where the stock is that we've now put officially on hold. There's about a year's worth of new construction activity in Brisbane that we've put on hold. Around Australia, we've put about over 3 million square metres of space on hold. Most of it in Brisbane is in either the M1 corridor or the Western corridor, as you might expect, those sort of burgeoning, fast-growing areas. I guess one of the biggest legacies of this cycle will be the change in land values, and we're seeing falls in land values of anywhere between 20 to 40% in Sydney and Perth, much less in Melbourne and Adelaide, where land values hadn't really increased as much as we've seen in those other places. So as you can see here, our quote is that land prices are now starting to stabilise, but across the metropolitan area overall, there's been quite a severe adjustment. The investment activity in the industrial market, you can see on this chart, it's about $350 million in the last 12 months. That's also roughly half what it was the year before. Interestingly, if you look at the categories, almost the whole of the industrial market has been driven by the sub $30 million bracket. And that's an interesting benchmark. That's also the benchmark that banks tell us they're prepared to lend under that level. Over that, the banks just are very selective about where they lend. So it does support the theory that it's the private investors who are really keeping the industrial market ticking over at the moment. The yield patterns in industrial, we think, are also starting to stabilise now, and it's been quite a swift, it's a very honest sector, very swift turnaround in the yield quote in industrial, about a 200 to 300 basis point softening. It's just starting to see it stabilise now, about 8.75, 9%. Very similar story around the country too. But just all the markets have started from a different position. They all seem to be finishing around about that 8.75, 9% for prime grade office warehouse stock, and a little bit softer still, about 9.5 to 10% for secondary stock. So by the way, that translates into something like a 30% drop in capital value in the industrial market. So the outlook overall, the pricing adjustment we think for industrial is now all but done. Rents will remain broadly stable for grade A quality stock. The swift reduction in construction activity is in some ways been the thing that saved the market because it just preserves it for the time being. Pre-lease demand will return with consumer and import activity from late 2010 on. And we see much lower land values really being the key legacy of this adjustment over the last 18 months.